We saw PPI come in this morning much better than expected, and this thing actually pushed to highs of $422. Now, the thesis that we've had for Tesla over the past couple of weeks has been bullish, but that we were expecting price to continue to pull back into our institutional buy zone before we became aggressively bullish once again. This is why I've been focusing on selling cash secured puts and moving away from my normal leap or call options that I would be focusing on. Once we can get the BX to start making higher highs, much like we saw back here from November to December, that is where I will be looking for that next stage breakout to the upside. Now, the main reason that we've been expecting price to continue to consolidate and slowly move its way down to 350 is because of the loss of buying pressure on the weekly chart. Looking at the bottom of your screen, you can see that the weekly BX was continuing to make higher highs each and every single week, right up until December 27th. Once this started making lower highs and then started flipping to dark green, this is a clear indication that buyers are leaving the market. And normally the only people who are still entering the market at this point is going to be retail investors, which are people like you and me. And you have to understand, as much as it sucks, in most cases, retail investors are going to be the liquidity for Wall Street, meaning that Wall Street has been accumulating their positions within these sideways consolidations and then selling them as we push into higher highs. You can see this by the massive expansions, followed by consolidation, a massive expansion, and now followed by a consolidation. This even happened all the way back here in June, when price broke out the very first time from that wedge and pulled all the way back down to test 175. And now this doesn't necessarily mean that I'm bearish either. Like, I would not be looking to take a short position. I would not be looking to actually buy directional puts. Instead, when we see this uptrend but buying pressure weaken, we can do one of two things. We can either, one, sit out and just wait for buying pressure to step back into the market, or two, if we have more capital and we just want to look to make a couple of percent per week, we can start selling cash secured puts into that institutional zone. I have courses on doing that down in the description. It's completely free and I highly recommend it. And the fact that the BX is showing buying leaving the market is why we haven't been trapped trying to time the bottom on Tesla yet. In order for me to become aggressively bullish again, to start buying directional call options or loading up on shares, I need price to either pull back into $350 to $340, or I need the BX to start making higher highs and higher lows again, which would most likely happen if price broke and held over $420. And since that didn't happen today, the next catalyst that could make it happen is CPI tomorrow. So if CPI comes in tomorrow hot and not what the market wants, expect a pretty bloody sell-off back down to 350. If it comes in much cooler than expected, then look for the pushback to 420. If we push and hold over 420, then we will become aggressively bullish once again. And in the meantime, we can either sell cash secured puts or simply sit on our hands. Make sure you hit the subscribe button and follow if you're watching this on X, because as soon as our bullish requirement is met, I will be making a video letting you know. As you know, I have removed my aggressively bullish stance on the S&P 500 a couple of weeks ago. If we look at this upward trend that's been happening on the S&P 500, the BX trender, which is this oscillator at the bottom of your screen, started to make lower highs, which indicates that buying pressure is normally leaving the market. From this point, we had that massive sell-off on December 18th when the Fed came in extremely aggressive and hawkish as far as their outlook going for 2025 with rate cuts. And at that point, we've basically seen the S&P 500 continue to sell off since then. When the market is in a strong uptrend, I don't look to short these types of sell-offs. I'm only going to look to short the market when we are in consistent downtrend, making lower highs and lower lows. Instead, in many situations like this, I will simply sit out or focus on selling cash secured puts. Something else that we've been covering here is the fact that we had a head and shoulders pattern that's been forming since November as well. A head and shoulders pattern occurs when price breaks out, pulls back to a support level, pushes up to make a higher high. This is important because it looks like strength is coming into the market, only to sell off, more importantly, not to a higher low, but to an equal low. This is normally the first sign that this is going to be a head and shoulders pattern. The second sign is that if we look at the BX trender at the bottom of your screen, the weekly is currently red, which means that there's normally not going to be enough money coming in to push this into a higher high, meaning that price will usually react weak and make a lower high once again, selling off into a prior equal low. This is why I've had a target on the S&P 500 for $570 for the past couple of weeks. Now, keep in mind, I'm still bullish because of the trend, but this is just not a time from a buying pressure standpoint that I should be risking capital. Instead, what I'm going to look for is for the weekly BX to start making higher lows and then turn green. This will be the indication that buyers are stepping back into the market, and that's when we're going to see the full breakout back up into higher highs. And so best case, CPI comes in very strong tomorrow. We break over $590 this week. The BX makes higher lows, and then we get a beautiful breakout and rally for the rest of Q1. Worst case tomorrow, we see price sell off to $570, and hopefully it will hold at that point. I'm still bullish, but we need to see buyers step into the market. Since the middle of November, I have paused my bullish outlook on Nvidia. If we zoom out, you can see that we are still uptrending aggressively, which is one of the things that we want to focus on when we are trading. And that's why I've been playing Nvidia long for the past couple of years. Now, with that said, I want to only be focusing on going long when there is buying pressure in the market. So what we want to see is the BX trender, which is the indicator at the bottom of your screen, start to make higher lows on the weekly and then start to make higher highs. This is an indication that buyers are entering the market. And this is the type of environment that we want to be trading in. This type of breakout is known as an expansion. There are essentially three modes in the market. The first is going to be an expansion, which I have highlighted in green. This is when a stock is breaking out within an uptrend and we have buying pressure on the BX alongside of it. This is our optimal time to be long on a stock. The second mode is going to be called a compression. This is highlighted right now in red, and this is when the BX is showing lower highs or lower lows on the weekly chart while we are in an uptrend. This is normally an indication that price could sell off, but in most cases that we are going to trade sideways for a couple of months. This is honestly a really good environment if you're somebody who believes in Nvidia long term and wants to sell cash secured puts. Cash secured puts work best when we are in a bullish market, but price is consolidating. This is normally what I will focus my time and energy on. And from then, we will simply wait for the BX to start to make higher lows once again, and then look for our potential expansion back up to 170 within the next 2 to 3 months. But that has yet to happen. The last week of December, we became bullish on Nvidia because we were breaking over this resistance level and the BX was showing higher lows. This flip from dark red to light red is an indication that buyers are entering the market. And that's why we decided to go long, and we are expecting that breakout up to 160 and 170 to be much faster. Now, that event that was pushing the stock up was basically the hype running into CES. And since then, semis have pulled back drastically. So there are times where this strategy just doesn't work. And this would have been one of those. We still would have pulled out maybe a 4% profit or broke out at even. But now that we are trading once again under this level, the BX has flipped back to red, meaning that buyers are not entering the market at this time. The lowest price target that I've had on Nvidia for the past couple of months has been down at $120. The reason for this is where we have our point of control on the volume profile. The volume profile is the indicator on the right side of your screen, and instead of normal vertical volume bars that tell you how many shares were traded within a day, this indicator actually shows you where those shares were traded over the past year. And you can see the majority of shares have been traded around $120 to $125, which normally acts as a significant support or resistance level. And that's why my target to be selling cash secured puts or waiting to buy is down at $120. And with CPI coming in tomorrow, that is really going to be the catalyst that is either going to continue to drive price action back down to 125 or 120. Best case scenario, CPI comes in cool tomorrow, we see this push back up to 140, and the BX starts to make higher lows once again and turns light red. That is our indication that buyers are stepping in once again, and from there, we can take more of an aggressive approach on Nvidia. All right, ladies and gentlemen, let's talk about AMD. This stock has been my worst performing stock in the past year. And a lot of people are asking me if I can start covering this because we took some losses on this back in November, took some losses in this at the beginning of January, and I really haven't touched this or covered it since my stop loss triggered. Now, there's a couple reasons of why I wanted to enter this position in the first place. If we go to the daily chart and we zoom all the way out, we take a Fibonacci retracement from our most recent swing low of October 26, 2023, and pick that as the bottom of the range that we will look at, and then bring that Fibonacci all the way up to highs on March 8th, 2024. If we pull this Fibonacci retracement all the way out, you will notice that the key area that we are sitting in right now is going to be the 0.786 and the 0.826 Fibonacci level. This just simply represents a 78 to 82% retracement from high back down to this current low. This area is extremely important because this is normally going to be the absolute lowest that institutions will allow a stock to pull back into before they save the bullish structure, and then price will continue to move its way back up into all-time highs. We've seen this happen before back in 2023. Fibonacci from swing low up to swing high. You will notice that price pulls back right into that smart money zone, finds a bottom, and then continues to rally. This is what I was looking for. And unfortunately, every single trade cannot work out, and we actually lost twice on this. The initial reason that we entered this position is because the BX trender stopped making lower lows and began to make higher lows. This is very important because this shows that buyers are stepping into the market. And this is normally the first sign of a bottom. Price comes up, taps 125, pulls all the way back down to 120, and creates a higher low. This was a good sign because I was expecting now at this point for price to come back up, test a higher high, pull back down, test a higher low, and then come back up to fill the gap at 135 to 140. Now, as you can see, that didn't happen, and we ended up taking about a $50,000 loss across most of those call options. And at this point, I still believe that AMD can do very well in 2025, but before I put my capital on the line once again, I need the BX to make a higher low once more. Now, a lot of you might be saying to yourself, if you've been burnt on this twice before, why are you going to enter again? And the main reason for this is because the risk versus reward is off the charts at these levels. With even a 50% win rate, the upside here is massive. You can see following this last time, we would have bought at 138, actually made about 5% that we would have never cashed out on, and then actually ended up losing 4.5% by the time we exited the position. The second time, we would have actually ended up making a profit if I closed here, but instead I decided to hold through that breakout, and once again, worst case, we would have lost 4%. And so understand, 2 4% losses are more than worth taking if this thing moves back up to 160 the way that we're expecting. I will gladly take an 8% loss cumulatively for a chance at a 40 to 50% upside. If you want to learn more about all of the indicators that you see in this video, as well as the proprietary settings and the step-by-step trading system that I've built, you can take all of our courses completely free with the link in the description.